Well, hello there. It's August 23rd. Boy, again, one more week and 8 more days, and this month is over, and September's here again, and that's when the market really begins to move. But let's talk about the bond market. Here's what you need to know. Right now, you're looking at the long bond, the 30-year futures contract. The reason we're looking at the 30-year futures contract is because the current economic environment favors that the Fed, or is implying that the Fed is going to lower rates another quarter of a basis point next month in September. That's what this market is pricing in right now. And that's why it's higher. And if that happens, the market will go even higher, the bond market. Now, the reason is bonds and interest rates are inverse. Interest rates go down, bonds go up. That's just economic 101. So look for a strong rally in the bond market. There's right now, the bond market is pricing in close to a 90% chance that the Fed will lower rates again. But here's the interesting part. Let's say they don't. Just a few days ago, the Fed said, well, half of us wanted to lower rates half a basis point. The other half didn't want to do anything. And then they met halfway in the middle and lowered rates a quarter of a basis point. Well, if the Fed changes their mind, and it's very possible because everything is a little touch and go right now with China and tariffs and other global economies having inverse or negative interest rates. So right now, if the Fed says no, or if today Chairman Powell says there's a good chance we won't raise rates, we're going to leave rates where they're at, we're going to see the bond market go lower. And we're going to see the stock market go lower as well. Because if the bond market is pricing in a 90% chance that Fed rates will be low, that the interest rates will be lowered, then the stock market's anticipating the same as well. And if that doesn't happen, we can expect a decline in the stock market. Moreover, I'm looking at the futures contract right now. We're down right now. We're still in twilight zone. We're between the 50-day and the 200-day moving average. And I call that the twilight zone. And unless we see a real major catalyst like the Fed concretely committing to lowering rates another half a basis point, or quarter of a basis point, the odds are we're going to continue seeing this congestion. Why? Because there's no catalyst to drive the market higher right now. Earnings are behind us. There's no resolution with China. The best we got from President Trump was we're going to delay things another 90 days. Well, that gets priced into the market within one session, maybe two. That's not a long-term projection. That's just a Band-Aid. And again, giving something a hard date like 90 days, boom, the market will price that in. If the Fed said, or if Trump says something like, we'll see what happens in the future, well, that's speculative. But when they say 90 days, that's concrete. Anyhow, the market's down overnight right now. We're expected to open a little bit lower on the SPY. The S&P, the E-minis right now, right around the 2,900 level. The SPY should open right around the 2,900 level. Don't get bullish. The market's not going to get bullish till we're way above 2,950 level. That's the 50-day moving average, at least for 2 sessions. That's what I want to see. Something similar to what happened right here in the beginning of the summer. Notice we had 2 sessions above, and then the buying pressure started coming in. We're not seeing that yet. We're still choppy. We can continue seeing this choppy trading range that we've seen now since, for the predominantly most of August. We can continue seeing this for another few weeks or maybe a month. So don't get so excited about the bullish cycle till we have at least 2 days where price action is completely above the 50-day moving average. Watch the Fed announcement. It's going to happen at 10 o'clock. That's when Chairman Powell is going to start talking. Listen closely to what he says. If you hear something like, the odds are strong, we're going to lower rates again, it's almost a done deal, expect a higher stock market and a higher bond market, at least for the next few days. If he becomes a little sheepish and says, well, we'll see what happens, we don't know, the economy is stable, employment data is coming out at 209,000, which is below 4-week average. If he starts talking bullish economy, if his language infers bullishness in the stock market and that there's no need to lower rates again, the odds are that the stock market will go down and the bond market will too. Because as I said, there's a 90% implication in the bond market that there's going to be another rate drop next month. So that's very important. There's that anticipation, so it's priced in. So if it doesn't happen, it's like pulling the rug from underneath the bond market and ultimately the stock market, because the stock market needs lower rates to continue going higher. There's just no other catalyst right now to make it go higher. Economy is in between stages, in between cycles. So we need to see something strong, a major catalyst drive the market. And there's just not one right now. We may get one in the next few months. We may get better Fed data, better earnings. But right now we're kind of in the middle of a wait and see territory. I think that's the best way to describe it. Folks, you have a wonderful weekend. If these videos are helpful to you, please let me know. Reach out to me, support@marketgeeks.com. Like our channel, subscribe to our channel. I do these videos every day for you, so you'll get a better understanding of the framing or the positioning of the stock market for the current day, for the current session and forward. So please let me know if you like these videos. Reach out. Love to hear from you. Support@marketgeeks.com. You guys have a great weekend. Bye.